Association.
Sorry.
No problem. As I was saying, Jordan Levine is here. He is our Vice President and Chief Economist for the California Association of Realtors, where he is responsible for the housing market and economic trends and analysis, policy analysis, and data work in a variety of contexts. So Jordan Levine, the floor is yours.
Thank you so much, Ro, and thanks to Tanya for inviting me to be here today. I'm going to share my screen so that we can talk about the housing market, and I can show you some pretty pictures about how things continue to do well. So, there's the projection that we just released last week is hot off the press. So you're actually the first outreach that I've done since we revised our 2021 numbers on the basis of what we've seen happen through the first 6 months of the year, and talk a little bit about the kind of transitory effects, some of the effects that may be a little bit more permanent as a result of COVID, and what it all means for the housing market in general. If you have questions, I'll try and keep an eye on the chat. Let me know, and I'll do my best to answer them. I'll also send these slides to Tanya after the fact, and we'll post them on C.A.R.org, so you don't got to worry about taking all kinds of notes or anything like that. You can actually have these to the extent that they're useful in your conversations with your clients and things like that. But as a kind of post-mortem, when you look at both just the kind of broader context or drill into the data itself, it's pretty clear that COVID changed a lot, right? There was big changes to the economy, right? Big impacts in terms of job losses, the nature of those job losses. And there was also some kind of structural changes, I would argue, that happened in terms of demographics that really played into the hands of the housing market in particular. And the kind of nature of this crisis actually made housing kind of one of the bright spots in the broader economic landscape, caused us to kind of punch above our weight, which we've been doing for the better part of the last year or year and a half, 16 months, more or less. Some of those changes, again, have been more transitory in nature, right? We're already starting to see early signs that things are kind of getting back to normal in terms of where the home sales are now taking place, the industries that are starting to come back, while other changes seem to be a little bit more persistent. And I think that will have implications for just the kind of broader recovery, and also through the lens of housing demand in particular. But it's clear that not everything changed, right? There's certain things that are the same or even worse than they were before. And I would argue that because housing has become more important to us than ever before, we're actually seeing a lot of the underlying challenges that were in place before the crisis have now just been magnified, particularly when it comes to supply, right? We already didn't have enough supply out there. Now we have, 2.8% mortgage rates, and, the fact that homes are more important to people than ever before. And that really, again, kind of makes it even more acute in terms of that lack of supply. And so when you kind of put all that together and look at it from the standpoint of what does it mean for the rest of the year in 2021 and what we can expect for the housing market, for our businesses in 2022 and beyond, I think that a couple of things, are kind of the key takeaways. One is that we're still relatively optimistic, right? If you get to the end of our presentation here, and I don't scare you off before then, you'll see that we're calling for double-digit growth in both sales and almost in prices. I think we're calling for about 7-8% growth in sales, even after we closed higher with more sales last year, right? So that's going to be 2 years in a row of continued increase. That being said, though, we're now starting to get into the phase of the recovery where we're butting up against a little bit more headwinds, both in terms of, prices, affordability, which are going to be challenging to some folks that, just are going to see themselves get priced out of the market, right? And we are starting to see signs of that buyer fatigue. The other thing, and we're a little bit more optimistic on rates now than we were a month or two ago, for example, we're still probably at the end of the declining rate cycle. And so even though we don't, we're not really pessimistic when it comes to how fast rates are going to go up, we do think rates will eventually go up, and even small changes in interest rates at these high prices that we've now gotten to have significant impacts in terms of what it costs in a monthly payment. Even a 30-40 basis point increase in rates, which is pretty modest by historical standards, translates into, especially in a market like the Delta, right, where we're seeing, $820,000+ prices in Brentwood. 30 basis points translates into several $100s on a monthly mortgage payment potentially. And so even as we're optimistic, we also want to have a kind of nose to the grindstone type of approach to our business, and also kind of try and freshen up those scripts, right? Because we're seeing a little bit more inventory come online. We're seeing that buyers are a little bit more reluctant, and those are kind of a bit of a change from where we've been a year ago when we just had so much insatiable demand, no supply whatsoever. And so again, I think there's an opportunity there for buyers who've been discouraged now that there's more inventory there, right? Sellers have to be a little bit more realistic as they have more competition from a few more listings out there. So ultimately, again, still pretty optimistic, but again, you want to keep your foot on the accelerator because we are starting to see those headwinds start to manifest in different ways in our market. When it comes to the housing market, one thing that COVID made abundantly clear is that from the standpoint of home sales and rising home prices, the economy is the boss, right? What happens in that broader economy really does still translate through. This is also great from the standpoint of, me having paid those student loans for so long that Econ 101 does in fact work, right? But you can see why in that initial phase of the shelter in place, that there was this unprecedented hit to the economy. In fact, between February and April, we lost more than 2.7 million jobs here in California. It was just basically a pressing pause on economic activity that showed up almost overnight, which practically never happens in my business in terms of tracking this data. And yet you can see that as we kind of got our arms wrapped around the nature of the crisis, what it meant to be sheltered in place and do social distancing and all that stuff, we were able to kind of ratchet back a little bit from that initial March, April, May kind of clamp down. And as we opened up, we almost immediately went back to a job growth mode, right? Between the end of April and November, we added back almost 1.1 million of those jobs that we had lost. Now, keep in mind, November is when the COVID cases really started to ramp up and get, to unprecedented levels. At one point, we were at about 60,000 cases a day. Press pause on the economy again, go right back to losing jobs. Between November and January, we had a tough holiday season for a lot of folks who were working in hotels, bars, restaurants, that kind of thing. But again, as those numbers crested in January, between the end of January and June, we went right back to adding jobs, right? So I bring this up because you can see how big the impact was, 2.7 million people losing their jobs, but also you can see just how closely tied the economic activity is to the broader public health numbers. And I think that's especially relevant in today's environment where we're seeing a rebound, right, in those COVID numbers, and likely, for those of us in the Bay Area are already seeing those mask mandates come back and other restrictions be put in place. That is relevant, not just from a kind of, public health standpoint, but obviously this affects the broader economy and therefore the housing market. Now, one of the reasons why housing was so strong is because not all segments of the economy were created equal. This is kind of my George Orwell kind of Animal Farm reference, right? But some sectors were more equal than others, shall we say, because, if you look at retail sales just as kind of a microcosm for the broader economy at large, and you divide out retail sales between online spending and what gets spent at brick and mortar retail sales, you can see that, the brick and mortar shops, the Main Street economy, bore the brunt. They bore the entirety of the decline, right? In fact, online sales jumped up about 25-30% almost overnight, with the onset of the crisis. And you can also see that those numbers continued to go up, whereas it took us about 6-7 months just to get back to pre-crisis levels for Main Street, and have grown much more slowly since then. So there's still a big gap, and it really depends on who you were in this economy to determine, how impacted you were. In fact, if you look at our 4 lowest paying sectors in the state, those are the ones that bore, the full brunt of the crisis. Leisure and hospitality, that's hotels, bars, restaurants. Other services is our nail salons, our barbers, our dry cleaners, all of that stuff. Retail, self-explanatory, and administrative support, that's all of our office staff, our administrative staff, right? And you can see that, again, about 90% of the jobs that we lost were in those 4 industries. Our 4 highest paying sectors were much less affected from a relative standpoint, right? On a percentage basis and in terms of the number of jobs that were actually lost. And if you think about the nature of our housing market prior to the crisis, you really had to be in one of those high income categories to be able to afford home ownership in the first place. And those were the folks that were, again, relatively unimpacted by the crisis. Those are the folks that have the most remotable jobs, right? If you have a laptop and an internet connection, you can continue working. We can't clean hotel rooms remotely at this point. And so, we had that going for us from a housing demand standpoint. We also had the fact that those folks were now working from home, right? So they had more flexibility and they needed more space, right? So they had this kind of dueling pianos vibe when they're in their downtown San Francisco condo, both trying to do their Zoom meetings, and you saw that also motivate a lot of housing demand. Another way to look at it is to think about, not from a kind of consumer spending standpoint, but you can look at the kind of Wall Street rebound, right? Which Wall Street was hit by the onset of the crisis. We went from about 100% index down to about 85. That means we shrunk by about 15% in terms of those equity markets, but rebounded very quickly. In fact, by the time the first shelter in place orders were actually issued here in California, the stock market was basically already back to pre-crisis levels. Currently, it's about 73% if you're looking at the NASDAQ, 38 to 49% if you're talking about the Dow and S&P compared to where we were before coronavirus. Let me show you that same index traced out for the jobs market, right? So again, if you're a high income earner, if you own stocks, right, your personal economy has come back much more quickly. If you're a worker at a hotel, you can see that the broader kind of economic picture has been much slower to recover. And so you again had this kind of tale of 2 economies, if you will, where folks at the high end of the income spectrum, remotable jobs are actually doing even better than ever before. Financially, they're still more employed pound for pound, and their assets have grown substantially in the wake of this crisis. And then you throw in this huge incentive of 2.66% mortgage rates, which the Freddie Mac number hit at one point several months ago. And that really did create this kind of additional incentive above and beyond the fact that you needed more space now, that you had more flexibility to not have to drive into the Embarcadero every day for this, Facebook job or what have you. And now the cost of borrowing hit an all-time low level. And that really did kind of create this perfect storm that played right into the hands of the housing market. And indeed, what we saw was that the number of folks who actually finally took that plunge to get into housing was at a decade high level. Almost 40% of the market was first time buyers last year, which is actually, not just the highest level in a decade, it's above the long run average. And so that is a trend that had been going in the wrong direction here in California. But if you look at who those first time buyers were, and you kind of interpret these numbers through the lens of that economic data we just talked about, you can see that the first time buyers were those relatively affluent long-term renters who, for whatever reason, because they wanted to, maintain close proximity to work, they didn't want a long commute, they liked being able to kind of ride their bike to Trader Joe's or whatever the reason was, they finally had that incentive. That perfect storm finally did get them motivated to put their foot on the property ladder. You had almost a third of first-time buyers putting down significant chunks of money, both because they're folks with stock portfolios They have work at companies that recently IPO'd, but these are also highly correlated with folks that have, boomer parents with a lot of home equity that they are willing to cash out at 2.6% and help them get that foot on the property ladder now that the timing was right. Conversely, we didn't have this market that was driven by basically, no down payment loans, right? You remember in 2006, all the ninja loans, the no income, no job or asset type of borrowing that was so prevalent that created all that systemic risk, such that when we had the economic shock, the Bear Stearns, the Lehman Brothers, that it really just got the snowball rolling on what were much deeper fundamental imbalances in the mortgage market that you see here. That was a fraction of what it was last time around. In fact, I would argue we've been too tight probably on underwriting and didn't let enough people get in and take advantage of these 2.6% rates. The other thing that we really saw COVID do, in addition to driving, affluent first-time buyers into the market, was to drive a lot of folks to buy either vacation homes and second homes. So folks wanted to go ride out the quarantine in Bethel Island and have a dock with their boat parked out front, right? So they could do the Zoom and then go cruise around. They wanted to go to Tahoe and be able to mountain bike, and do all of that stuff. And so again, you also saw not just affluent folks buying first time primary residences, right? You also saw a lot of folks buying these second and vacation homes, and we expect that that continues. And actually, if you think about that also through the lens of that economic data that we shared, high income earners doing well, stock market doing well, rates at all-time low levels, it's almost a no-brainer for those folks to have bought, cabins in Shasta and condos in Mammoth and all of that stuff that was so prevalent that we saw last year. And what it all culminated in is the fact that the housing market is just continuing to punch above its weight. We're head and shoulders above the rest of the economy. Through the first 6 months of 2021, we are up more than 33% from where we were in the first 6 months of 2020. And keep in mind, that includes when sales were starting to come back in May and June of last year. They were actually growing by double-digit percentages. And so we continue to go even above that pace, even as prices hit all-time highs and inventory falls to basically all-time low levels. And so we saw all of those economic trends and kind of structural changes really materialize in this really substantial growth for the housing market, and it has resulted in a market that is just incredibly competitive out there for buyers, right? That we're at a median time on market now statewide of just 8 days, right? Which is just absolutely incredible. That's the time it takes for a listing to hit the MLS and go pending, right? Which is just absolutely incredible. And as they go so quick, what you see is that the competition over those limited amount of units is just incredibly high. We had a median closed price that was 4.1% above list price, right? So, and that's a median. That means that 50% of what closed in June closed more than 4.1% above asking price, right? And I know in our area, we're looking at 7-8% as a median sales to list price ratio. So we're even more competitive than the state as a whole, but this is something that's happening all across the state. And actually, if you just take away the 4.1% threshold for above or below and just ask how many were above list price, right? 71% of what closed in June closed somewhere above list price. It might not have been 4%, but at least more than what the seller was actually asking for. And so it's just been an incredibly competitive market because we have all of this demand butting up against such a limited amount of supply. And that's why we see prices rising to these unprecedented levels of 820,000 as a median statewide, right? That means that half of what closed in June closed for more than 820,000. That's just an incredible number. Actually, the last 3 months, we've sold more homes over $1 million than we sold homes 500 and below, which, almost all of California's housing market used to be 500 and below, not even that long ago, right? And so, we're seeing prices go up by over 30% on a year-to-year basis, setting new records. And actually, I don't know if you guys get this, but we produce this report for Tanya every month, and this is happening right in our own neck of the woods as well, right? The median price, and this is basically for the 5 Delta cities. We have Pittsburgh, Antioch, Oakley, Brentwood, and Discovery Bay have a median price now of $704,000 in June, up 28.2% from where we were at this time last year. And I mentioned we're even more competitive, right? That we have a median sales to list price ratio now of 107.2%. So we're, I brought the local data, and as you'll see, as we kind of tick through each of these individual cities, in some ways I didn't even have to, but I didn't want you guys to feel left out. But, the moral of the story is this is happening right here at home. Pittsburgh up 30% in closed transactions, up 27.2% to a $620,000 median price, right? Antioch is up almost 20%, even again, as prices are up 26% with just no days on market really to speak of. Oakley's not up actually, but they're still selling more homes than are even on the market at any given point in time because the churn is just happening so fast. They go up, 7 days later, they go pending. And so even as new listings come online, the total number of actives is falling, right? Because you add new listings, then you close 57 transactions, right? And you fall farther behind the 8 ball from an affordability standpoint. Brentwood now has a median price of $850,000. I used to go to my mother-in-law's house in Concord, back in 2005 and 6. And I was shocked when their house in Concord was 700,000 back at the height of the last bubble. And now we're looking at Brentwood Discovery Bay, well in excess of 800,000. Again, even as sales continue to go up, right? You can't sell them fast enough at 850,000 even, which is just, again, a testament to how COVID changed the nature of demand for housing, and those folks with the economic wherewithal are actually doing better than ever financially, and so what we see is that all of that played itself out into a really strong housing market. One of the things that did change, at least over the short run, was kind of where folks bought and what they bought, right? We didn't have that gun to our head forcing us to go into San Francisco. And what you saw was that even though we were in the midst of the biggest, most unprecedented hit to our economy since the Great Depression, we actually had 20 cities that grew by at least 40% in 2020, right? Which is just pretty incredible considering that we lost about 2 to 3 months worth of home sales. I should note too that I limited this to cities, quote unquote, that have at least 10 transactions a month, right? So we looked at it over a 3-year period. But if you look at what these cities were, I would argue that you can categorize those into basically 2 primary categories. They were either resort / really high quality of life areas, right? You're talking about Big Bear, you're talking about Lake Arrowhead, Tahoe, Arnold, South Lake Tahoe, Truckee, out in the desert, Palm Springs, Indian Wells, those type of places, or the markets with really high home prices where really affluent people who owned all those stocks and have all that home equity went to. So the other 4 was Malibu, Montecito, Tiburon, and Rancho Santa Fe down in San Diego, all markets that have a median price of at least $2.5 million, right? And the other thing that it changed was, again, that need for space. When the crisis turned on, here's the median square footage of a closed sale in California. And you can see that for, years, it's been relatively stable at about 1,750 square feet. By June of 2020, that number had jumped up by about 100 square feet, right? So people were getting a 10 by 10 square foot office, right? Or a 10 by 10 foot office to do their Zoom meetings and all of that stuff. As the numbers started to come down, we saw that start to normalize. These also are very closely tied to the COVID numbers. When COVID spikes, we want more space. When we see the COVID numbers go down, we think it's okay to live in condos again. Then when it spikes, we decide we need bigger backyards again. And so you can see that kind of influencing the numbers here. But even as we saw, a ton of folks move to Big Bear, move to Tahoe, Truckee, and what have you, I would argue that you're starting to see that not everything has changed, right? If you look at where we are through the first 6 months of 2021, 30 cities now have doubled or almost doubled. I put the threshold down to 98% so I could have an even 30 in terms of number of cities. But if you look at where the demand is or where the transactions are happening, it's started to shift back to our urban core, right? You still see places, the really high income places like Pebble Beach, Pacific Palisades, Malibu doing particularly well, but you're starting to see cities near our core employment centers, right? Places in LA like Marina del Rey, West Hollywood, places in the Bay Area like Menlo Park and, Sunnyvale. You're starting to see the demand shift away from some of those markets and go back to where the jobs and the people have always traditionally lived in California. So yes, some folks took advantage of the opportunity to leave the city. Yes, also a lot of folks are putting down roots where they traditionally always have. In fact, if you look at the parts of the state that are growing the fastest right now, it's San Francisco Bay Area and Southern California, right? And so again, I would argue that we shouldn't give up on our cities at this point, that there's still a lot of demand, and it's important to keep in mind that huge percentage increases for places like South Lake Tahoe and Big Bear don't equate to much in terms of actual lost residents from the standpoint of the San Francisco Bay Area. You get 300 people move to Big Bear, that's a triple digit increase, right? But 300 people from the standpoint of a 9 million person Bay Area is a relative drop in the bucket. And so, it's important not to get lost in that when we read these dramatic newspaper articles that everybody is kind of fleeing to Tahoe and we're all going to live in Truckee next year, right? And you can see that too when you look at the condo market, right? That initially, right, at the onset of the crisis, the condo market, which tend to be, predominantly congregated in these dense employment corridors, fell even more than the single family market. When single family sales were falling by 30 and 40%, you were seeing condos fall by 40 and 60%, right? But also on the right-hand side, as single family has started to come back, as cities have started to open up, you start to see the condo market coming back even faster than the single family market. All of this is just to say that yes, housing demand is coming back. Yes, people move to Tahoe and Big Bear, but it's a far cry from full mass exodus from California's core, right? And that's why I think one of the reasons is that we're seeing the momentum slow is that the demand is returning to the core where we're most inventory constrained. And so even as we continue to grow by double-digit pace compared to where we were last year, you can also see that the level of home sales is now starting to butt up against this lack of inventory and the erosion of housing affordability that has come with it, right? So that's kind of what's changed, is that we saw the nature of demand really play itself out in terms of the what and where of the housing market, but we're already starting to see some of that come back to normal. One of the things that we do, expect to continue, though, is that at the margins, folks will continue to take advantage of that increase in flexibility. This is through the end of July, and this is our weekly survey of realtors where we ask about 500 to 1,000 realtors, where'd your seller move to? And you can see that about 30% roughly are moving out of California, and that will continue to be a pressure when folks don't have a gun to their head, again, forcing them into the office. Housing affordability and housing supply really motivates folks to look for housing in places like Arizona, Nevada, Texas, Washington, all those places that folks go. And I think that we'll see remote work, at least on some level, persist, and that will continue to shape the where of housing demand. I also think it's important to keep in mind that even though that kind of macroeconomic tide is rising, right, and you see that we continue to add jobs, we've got our unemployment rate down now into the single digits. It's still above where it was before the crisis, but moving in the right direction. That again, some sectors are going to be more equal, as it were, than others moving forward. And you can see that leisure and hospitality, although growing at a fairly decent clip, still has a long way to go to get back towards pre-crisis levels. And I think online shopping is probably here to stay, right? We've gotten really comfortable buying stuff from our couches on Amazon.com. And that's why even as the economy has started to reopen, you don't see that actually materializing into a lot more retail jobs, right? The hotels seem to be growing at a much faster clip, but I think that has implications for just broader economic activity, but also for things like commercial real estate, right? Because you haven't seen retail CMBS delinquencies, as an example, improve the way that you have on, apartments and offices and all of that stuff. And you can see that shown here. Some of the stuff that COVID hasn't changed, right, is our structural issues. We still have a huge problem when it comes to housing affordability. We're crunching the numbers for the second quarter of 2021 right now. And I can tell you, and I think 49 out of the 50 counties that we track, housing affordability deteriorated further in the first quarter, even as we fell to basically all-time low levels of interest rates. Only one county actually treaded water. Nobody improved, right? So one county was the same as it was in the first quarter. Everybody else had worse housing affordability. And we were already at a point in time where basically almost 3 out of 4 households could not afford the median priced home. And that's the kind of downside of having so much buyer demand, right? Is that when you don't have the homes to put them in, prices go up and more folks lose the opportunity. We've always had a huge gap in home ownership. That's going to be exacerbated now as affordability has deteriorated. And so that's going to be even more acute for Black and Latinx households here in California, which are already, up against it in terms of affordability and home ownership. And so that challenge, again, has only been made worse by the fact that so many people actually want housing, right? It's just that we can't fulfill that demand. And so it means that it goes to the highest bidder here. And of course, you don't have to look very far to explain why, affordability is deteriorating so much. We don't build enough. The green line is what the state says we need to build just to tread water on affordability. And you can see that we've hit that number only 5 times in the last 35 years. And so you don't have to do any kind of fancy econometrics. This one's basic arithmetic. When you have the second worst record in the nation on new construction relative to economic growth, then you end up with all these terrible records, right? Low vacancies on the ownership and the rental side, a record low. We only had 1.3 months of supply back in December, which has never been recorded ever before. That's why you don't have to look very far to explain the $820,000 median price here in California, which is also why we're the second worst state in the nation when it comes to rent burdened households, folks that spend too much of their income just making that monthly rent payment, why we're the second worst state in the nation for overcrowding. So even though we're rent burdened, we're paying too much on rent, even as we continue to pack too many people into these homes, because we just have to continue to shack up, and why we're dead last in terms of poverty once you take into account the cost of housing. So there's regular poverty estimates that have a kind of one size fits all poverty line, whether you're in Toledo, Ohio, or Beverly Hills, right? But there's another one called the supplemental poverty estimate, where they actually account for the cost of living. And by those standards, California is the poorest state in the entire nation. That's that giant sucking sound, right? That you hear dragging everybody out to Arizona, Nevada. They're not moving to Phoenix because it's an amazing place to live. They're moving there because you can get a 2,500 square foot house for $250,000 and afford to just run your AC, 24/7 basically. And that's why, California's population, for the first time in 120 years that the census has actually been tracking California population, actually shrunk, right? And so that is the bigger challenge moving forward, is that people want home ownership. In fact, they want home ownership now more than they have ever before, but we aren't providing the housing to put these buyers into. And guess what? They don't have those chains holding them into these downtown employment corridors just to have a good job anymore, right? And so I think that it kind of necessitates us getting serious sooner than later about the housing shortage, both from a realtor standpoint, right? Because we can't sell homes that don't exist, right? We have the buyers for them, but if there's not the homes out there, but also from an economic standpoint, right? How do we continue to grow our economy if people can't afford to live here, they can't achieve home ownership, and then they do move to Phoenix, right? And then we're kind of up against it from an employment standpoint. And how do we continue to have the kind of successes we've had that have led to everyone's benefit, really? And so that's the kind of bad news. The good news is that we're starting to see supply move in the right direction. Again, Econ 101 is starting to work. I'm feeling better and better about having paid these student loans for the last 20 years, because what's supposed to happen, right? What they told me on the first day of college at UCSB is that when you have too much demand and not enough supply, it pushes prices up, and that attracts suppliers, right? That you look around and go, oh, my goodness, my neighbor just sold their house for a boatload of money. They just went pending in 6 days with a bunch of all cash offers. And it does, in fact, bring sellers back into the market, on top of the fact that we just had a lot of pent up supply from folks who maybe wanted to sell over the last 16 months, but didn't want to worry about folks coming through their homes, doing peds, doing, all this crazy stuff. And now they're in a position to be able to do that. We also have Prop 19 now, right? So folks who have been scared to move because they didn't want to take a $20,000 a year property tax hit moving into their new place can now do so without suffering that property tax penalty as well. All of which I think are contributing to new listings moving in the right direction. And yet you can see that even as we've had our first couple weeks of growth, or first couple months, excuse me, of growth in new listings, this is how many we're actually putting onto the MLS. This isn't how many's active. This is how many we put on during the month. Those numbers have gone up over the course of the last couple of months, but we're still well below where we would be at a normal point in a kind of summer months when we were putting close to 30,000 homes onto the MLS every month. And so, yes, we're getting some new listings. No, we timed it not perfectly, right? Because it's already gotten to the point where we're starting to see that buyer fatigue set in. We do a monthly survey of California consumers. There's already, national housing sentiment indexes, but I didn't care what people in Toledo, Ohio thought about whether it was a good time to buy and sell. We cared about California. And so we started doing our own survey of 1,000 California consumers every month. Two of the questions that we ask related to housing sentiment is it a good time to buy a home? Is it a good time to sell a home? And what you can see is that the gap between the people who thought it was a good time to sell and the people who thought it was a good time to buy hit all-time high levels. And it has basically continued to deteriorate every single month since the onset of this crisis. People want to buy homes. They get out there and get out-competed. There's not enough homes for them to buy. People offer more money. They offer cash. They don't have contingencies. And what you see is that is starting to affect the psyche of buyers out there not feeling motivated to get into the market. We ask our members every week in our weekly survey of, again, 500 to 1,000, are you seeing more buyers get fatigued? Those numbers are going up. It's almost half. When we ask, are you seeing that number increase from where it has been in previous weeks? Again, we're almost to the point where 3 out of 5 realtors that we talk to say they're not only seeing buyers drop out of the market, but that they're seeing more buyers drop out than they were seeing before that, right? And so those numbers are actually going up. We see that in terms of the mortgage applications, which have been falling now for the better part of the last 2 months, right? In fact, have now hit double digits. And so when you look at our weekly sales index for California, it's just now starting to dip negative, but we've seen this coming for a while because buyers have been downshifting, both because they're kind of suffering from what I would call that brother-in-law effect that somebody told them the market's about to tank, right? But also because they're being priced out of the market, right? Or they're not able to make the numbers pencil when rates are a little bit higher now than they were before. We had pending sales go down in June for the first time in basically the full period of the crisis. And we also see that the list prices, not closed prices, right, but the prices at which homes are coming onto the MLS, the growth there is still positive, but it's not in that 30 and 40% growth range. And so what you see is that both sales and prices seem to be actually normalizing, right? That we're going from a period of extreme excess demand back to something that's a little bit more balanced. COVID, of course, is going to remain part of the conversation. And I talked about how closely the public health numbers tie to the economic numbers. And you can see that even though there's, holes in CDC reporting and we're missing some good data for a couple of days there, you can see those holes in the CDC reporting numbers are just absolutely terrible right now. But we still had over 11,000 new cases yesterday. And so this is going to remain part of the nomenclature. It's going to cause more, restrictions likely that will have impacts on the housing market. We're starting to see the numbers for vaccinations plateau at about 60%, which is below the numbers that we need for full herd immunity to be able to really get back to something that looks more normal. And so that kind of creates question marks, or it clouds the outlook, right? Because we were starting to see demand go back to normal, go back to the cities, right? Go back to condos, go back to smaller homes, right? But you can see that as those numbers started to spike up, we started selling bigger homes again, right? And so that could, the resurgence of COVID could further affect the demand for housing, the what and the where. And the other thing I think that it can do on the flip side is it might prevent rates from rising as fast as what folks initially predicted. If we, have to reclose down the economy, the Fed is already kind of looking for any excuse to not have to take the punch bowl away, it seems like to me. And if the numbers go up, then they might be a little slower to react. We still think we're probably at the end of the low rate cycle. We're not going to see tons of reduction in rates, but we have them just not going up as fast. We're still probably looking at something like 3.4% sometime next year. It'll just take a little bit longer to get there than what we originally forecasted. And so, again, the moral of the story, I think, is that the market is just normalizing, not tanking after being incredibly imbalanced for the last 16 months. And so when you kind of put all of that together, that yes, we're optimistic, but yes, also we're realistic that many challenges still remain. That's why we're calling for about a 445,000 unit pace this year in terms of closed transactions. That'll be about an 8% increase from where we were in 2020, which in and of itself was already a 3.5% increase from 2019, even though we missed a huge chunk of that spring home buying season. Unfortunately, we don't have enough homes to put all these buyers in. We could potentially hit, a 460, 470, even higher pace of sales, but for a lack of inventory. And that's why we're projecting that home prices are going to grow by more than 20% this year, likely getting to just shy of $800,000 on an annual basis. That means that they're not going to come down much from their seasonal peaks of about 820 where we are right now through the end of the year, which means that even as rates remain low, and we're forecasting that the annual average mortgage interest rate will be about 3% this year, which is less than what we were forecasting before, because we were expecting to approach closer to 3.3, 3.4% by the end of the year. Looks less likely, but even with those lower rates, you're looking at housing affordability that's going to continue to fall in 2021 to just 1/4 of households being able to afford that median priced home. And so, if you kind of put it all together, I would say that, yeah, COVID changed a lot. It created this kind of insatiable appetite for demand, but that initial surge of remote workers who had, stock portfolios that were doing really well, that moved to Tahoe, was kind of an initial surge. And we started to see demand return to the cities, return to smaller homes, return to condos, et cetera. But we do think that there's going to be at least some portion of that kind of augmented demand, if you will, that will be permanent. There will continue to be a premium on having extra space, on having quality of life, because I think that at least some percentage of remote work will be here to stay, especially the longer that COVID actually goes on. That being said, there's a lot of stuff that didn't change, right? And part of that is that we're really comfortable buying stuff in sweatpants on the couch, right? And I think we're going to continue to propel Amazon's future forward, right? And anybody else who sells stuff online, while the Main Street economy, struggles to get back even to where it was before the crisis. And I think that means that, we got to get really serious, in particular on supply, because, folks want this housing now, and they have flexibility in terms of where they go to actually get it. And that means that, we're going to continue to see the market do well, but it's not going to be that 510,000 unit kind of head and shoulders above everything else that we had enjoyed during that first kind of, 12 months of the recovery period. We are starting to see more inventory come online, and that will help to keep us at those elevated levels of home sales. But we've got a lot of folks who are either, again, drinking the Kool-Aid that the market's, poised for a decline, or that they just simply can't afford housing anymore and are going to go into a wait and see mode. So we're going to continue to see growth, but the nature of that growth is going to look more quote unquote normal, even though I hesitate to use that term, because, that kind of imbalance is starting to get back to normal. A little bit more supply, little bit less demand. And so that's where I would leave it. I see that I didn't go too long. So if you guys have questions and I haven't totally beat you into submission by now, I'm happy to entertain some of those too. And thank you so much for your time, and thanks to Tanya for letting me be here in row as well.
Tanya's on mute.
Oh, Tanya's on mute. Yep.
I'm so sorry. I do believe we do have a question. John Case has a question, and I do believe, Ro, don't we have one in the chat box?
Yeah, we have a question from John and another from Walter, I believe. So John, go ahead.
Thank you. Jordan, thank you for your presentation. You have essentially repeated what I've been saying for about the last 6 weeks up here in this little microcosm of California. couple of things that you need to extend your thinking on having to do with the median price and the impact it's going to have if and when the eviction moratorium ever ends here.
Yeah.
I suggest to you, I'll posit, if you will, that because we have such a few number of properties under the median for sale, it's simply because the owners can't sell them. They're prevented from selling them. And it's been that way now, and it's coming on 2 years.
Yeah.
And what that means is it's not going to solve the rental problem, certainly, but we are going to see people leaving the rental market, and the rental market's going to shrink. The rental market's going to shrink in a very big way when these people absolutely have to move out of their homes because they're the people who own them, who didn't invest in stocks and bonds, that they invested in real estate, are going to be trying to say, I got to get out of this mess because I can't trust it.
Yeah.
So what we're looking at here is I think we're going to see a large number of properties going on market under the current median, and it's going to be significantly under this current median, because we're looking at the East Bay here, or certainly East County, which is primarily a rental market. We don't have any large industrial employment. We don't have any big jobs, that type of thing. We have a very, very large percentage of renters, not the kind of thing you're going to see in Lake Tahoe, certainly. We're going to see lots of homes go on market, and it's going to have a deleterious effect on it because people who are now able to get back in, they're going to come in, and the supply might actually meet demand. And if that's the case, prices will stop going up and potentially go down. And if prices start going down at the lower end, then it'll drag some of the other ones down as well. So I don't share your 20% increase. I think that we're going to see it flat at best.
Well, that's for 2020. That's our 2021 projection. So we're already 6 months into 20. Yeah, there's almost no way it can't be 20% unless prices start tanking tomorrow.
Well, all we need is the Fed to just raise those interest rates, like you said, and I'll disagree with you on the Fed looking for ways to raise the rates. They're fighting it tooth and nail, that they're ignoring and denying that there's actual inflation involved going on right now. They're going to have to raise interest rates, and if they do, then we're going to be looking at higher interest rates than you're projecting. Again, we can flip a dime and see who comes up heads or tails and who's right and who's wrong.
I actually agree with you. My statement was that I think the Fed is looking for excuses not to raise rates. They don't want to take the punch bowl away. They want to continue to, yeah.
But they're going to have to. They're absolutely going to have to.
No argument there, but having to, seeing the writing on the wall and taking the medicine is a different story. So
we live, I think, in our little area. It's a specialized little area of almost 2 million people. But I don't know where the renters are going to go. I don't know.
No idea. I mean, yeah, it behooves, and it kind of really speaks to the need for underlying demand. I think you're right. Yeah. I think that folks will decide it's a good time to get out of the rental business, right? That we've seen. I think
without a doubt they're gonna pick up their cards and go home.
Yeah, definitely.
And those people who did invest in real estate that had the incomes, many of them now on forbearance, not just on the rental homes that they've got, because they haven't been getting rent for 18 months, but they've also had to, in many cases, had to take out forbearance on their own home to make up the differences of what's going on.
No, absolutely. And I think, the from the standpoint of kind of the biggest challenge I see facing the market right now is that we have too many buyers and not enough homes to put them in. Some folks getting out of the rental business could be just what the doctor ordered for home ownership, but it doesn't ease the kind of the underlying need for just more new construction, full stop, at every price point. Because
the problem we have, even though the state says we need more, the way they're going about it needs to be directed more at cities that say, listen, back off and start doing multi-residential, instead of threatening cities with, well, if you don't do it, we'll come do it for you. And that's really what's happening right now. So anyway, thanks for the time. I appreciate it.
Yeah, thank you for the comment. And that kind of touches on Walter's comment where he talked about how, the cost of the home is due to government regulation and things like that, and what C.A.R. doing about it is, that's basically the entirety of our public policy focus at this point in time, right? We're doing a lot of stuff in the fair housing arena, but the other thing that we're doing, the affordability question for me is all about housing supply. And so we're lobbying for changes to, the regulatory environment at the state level to enable more homes to be built. We're also attacking it at the local level, where so many of these decisions happen in terms of, how cities are zoned, how planning commissions vote to approve projects, how much support that local policymakers get for housing, right? In some ways, and we hear this all the time across the state, that local policymakers in some cases are in favor of housing, right? But what you're asking them to do is stick their neck out politically because nobody shows up to support them. So if they, you're asking them to altruistically, unilaterally commit political career suicide by doing the right thing. What we need to do is, really get out there and support those projects and do a better job of hopefully connecting the dots that the lack of construction and ownership opportunities affects the rental market. It affects people at low income levels, right? This isn't just about people who are buying $1 million luxury properties. We need to build new housing because there's a filtering effect. When people have new homes to move into, they leave their older, cheaper homes for people to get their foot on the property ladder. That is a very clear, connection. There's plenty of studies out there from USC and other places that talk about the filtering aspect of the housing market. By not building enough ownership housing, what do? You keep too many high income people as renters, right? And so what does that do to rents? It pushes rents up to the cost or to the price points that could be afforded by these people who would otherwise be in the home ownership market, but we don't give them enough home ownership opportunity. And so they bid up rents, and that, it's just this whole vicious cycle that filters all the way down to the entry level of the housing stock. And so I would say that that's what we're tackling on our public policy agenda in Sacramento and at the local level. We got to get those fees down, right? We got to do more on density bonuses. We got to do both the carrot and the stick, I would argue, to get more housing built at every level.
Yeah, whatever policy we have to be able to get the people who want to sell their homes at the lower end to be able to. And here in East County, we're stifled, we're hobbled, if you will, by the COVID rules and regulations. And by the way, I don't think it's going to last. The CDC now has control of the housing market nationwide. And whether you heard that yesterday, unbelievable. They couldn't get it through Congress, the Congress won't touch it. And so the CDC chief decided that they will extend nationwide until sometime in 2022. So it won't last constitutionally, but that's what they're doing. Yeah, thanks for your time again, Jordan.
No, thank you so much. Yeah, and I think, the moving piece, right? Getting people to sell their homes too, even above and beyond the COVID stuff, is like, we got to give people places to move, right? I could sell my house and make 820 grand, or 850 was the Discovery Bay median price. Then what do I do, right? I take my $850,000 and do what? And that's, I think, hugely problematic.
Does anyone else have any questions?
I have that effect on people, I know.
Right. Well, I'm sorry, Walter, did that answer your question? What Jordan just explained? Okay.
Yeah, and I see Sandy said property taxes in many areas are crazy high, and that's like also a function of the home price too. So, the higher the home price goes and the more you pay every year in the property tax. And it's just, these are all symptoms of a more fundamental cause of that basic arithmetic. You can't go from 25 million people to 40 million people and build 1/3 the housing that you used to build 3 decades ago and have prices do anything but go up for rents and ownership.
Right. Well, I know Patrick had a question, but maybe he had some connection issues. Oh, go ahead. Oh, I thought I heard someone want to ask a question.
Well, my email is also on the slide.
Yeah, he's got off. I went and checked. Oh,
sorry. Yeah, and so no, but you can reach out to me at any time if something comes up later down the road that you want to follow up or ask me. I work for you guys. My whole goal in life is to make sure that you guys make more money and get more people into home ownership. So if I can do that, then don't hesitate to reach out.
You just came back on, Patrick.
Oh, okay. Jordan, do you mind giving your contact information.
Absolutely.
for
Yeah.
us.
Put that in the chat.
Thank you.
Looks like Doreen has a question.
All right, go ahead, Doreen.
Oh, no question. I was just like, basically, yay, thank you for your time.
Oh, there was a clap. There was a hand raised.
Love those questions. Those are
My
the best.
fault.
I think Patrick's having a hard time getting it back in to ask this question.
Well, we'll give him Jordan's information and maybe he could just reach out to him.
Yeah.
All right, so before we take off, any other questions? All right, I know Virginia wanted to remind people of a class we have in a couple weeks.
Hi, everybody. Virginia Vieira Mitchell here with Warren Properties and also one of your 2021 directors for Delta Association. So just as a reminder, the next class or big class that we have coming up is a class being taught by the legal department from California Association of Realtors. And that class is going to be held on the 19th. It will be from 9 a.m. to 1 p.m. Delta Association is subsidizing the cost of this. If you were to go online, the cost is actually about $100 or more for this class. And this class, I believe, is $44, something around that. 42, thank you. So I'll go ahead and just quickly screen share the information, but you can always go online and go onto deltaassociation.com and you can see the events there. Or you can also go onto our Facebook page, Delta Association of Realtors. It's all on there, so you feel free to get the information there. It will be in our Delta News Views. Again, this is going to be a training for the changes coming up to the new contract at the end of this year. It's going to be taught by attorneys. And this is the place where you're going to want to ask all those important questions to keep you out of any legal hot water that might arise from that. So please make sure that you RSVP by then. And again, it is going to be held on August 19th at 9 a.m. and we'll end the class at about 1 p.m.
Thank you, Virginia. All right, I think we'll kind of close the meeting up.
Thank you, Jordan. Appreciate
Thank
your
you.
time.
Jordan.
Hey, Jordan.
Appreciate it. We'll see you on the next one.
Thank you.
Thanks, everyone.